Chihuahua caramba! Kevin O'Leary here. Money Court is all about dispute resolution. Businesses have problems, and I'm here to resolve them.
Money Court with Kevin O'Leary. New series, Wednesdays 10 Eastern on CNBC TV.
I'm Melissa Lee, and this is Fast Money. Tonight's trader lineup: Steve Grasso, Bono and Ison, Nadine Turman, and Jeff Mills. Tonight on Fast, we're following major new developments in the wake of that massive hack attack. One top cybersecurity firm issuing a dire warning tonight that hackers could strike again within the coming hours. We'll bring you all the late-breaking details straight ahead. Also ahead, a handful of big-name companies getting inducted into the all-time high club today. So should you fade these record runs? And later, our chart of the week, the stock soaring 20% since Monday and giving new meaning to the term high flyer. That is a big ol' hint. We will reveal that name coming up. But we start off with a record finish to a wild week on Wall Street. The Dow and S&P 500 notching new all-time highs, while tech took another tumble. The XLK Tech ETF now down more than 5% from the record high it hit exactly 1 month ago today. Among the biggest losers, PayPal's down 15%, AMD, Nvidia down 13%, Salesforce down 10%. So tonight, you get to choose your own adventure in the tech trade. Are the best days behind us, or is this a big old buying opportunity? Steve Grasso, kick it off.
I think the best days are behind for tech. If this is a textbook rendition of why you don't buy growth in a rising rate environment. Everyone on this panel has talked about it. Other panels on the show have talked about it. This is something where what's unbelievable to me, though, Melissa, is that everyone will rush back in. Human nature is you only buy what you know. So people think they understand an Nvidia or a PayPal or a Salesforce. So when they sell off, what do they think? Buying opportunity. And until you really get burned a number of times, you continue to rush into that burning house. So I think when people start to expand their base of stocks that they, quote unquote, know, you're going to see this repetitive nature of getting burned time and time again. So I do believe you're going to see the Russell continue its outperformance. I do believe you're going to see chemical names, material names, industrial names continue their outperformance. So for the near term, tech's best days are behind it.
Oh, that's quite a metaphor, Grasso. I mean, to compare certain tech stocks to a burning house, rushing in, getting burned, et cetera. I mean, Nadine, can you look me straight in the eye and say Alphabet's a burning house or Apple's a burning house? I mean, I thought these were value trades in technology. We're seeing this sell-off pretty much indiscriminate across tech stocks, harder, of course, amongst the higher multiple names, but also taking the big cap tech stocks. Is that the way we should look at this?
Well, I agree with you in that wouldn't call them burning houses because fundamentally they're pretty solid, right? But what you do see right now is there's more downside than upside. I think that's what Steve's getting at here. We're looking at last week when there was a lot of volatility. These things were trading at an implied volatility premium. What does that mean? It means that people are paying more for protection last week. But this week, they're trading at a discount. So a lot of that protection that they bought at expensive prices, they either unwound it or they're not buying it this week. So the asymmetry, which I think is what Steve's getting at here, is really not in your favor. So you have to be really careful. So what do is we do trade the chop. So it's not to say that you get to buy on one day that's a dip and hold forever. It's more of a trading environment.
Yeah, Jeff, from a previous call when we were planning out the show, that's what it sounded like how you viewed tech trade right now, that it's tradable at this point.
Exactly. I think Nadine phrased it absolutely perfectly. And I agree with everything Steve said, with the caveat that I think it's maybe tradable in the very short term. So if you think about stocks like Facebook, Amazon, Apple, throw in Nvidia, Spotify, these are companies that are now at longer term technical support. So I think that's a good thing. And if you go to last week, you only had 20% of the triple Qs trading above their 50-day moving average. That's usually a pretty good signal of at least a tradable low. It's not always perfect timing, but I think it gets you in the neighborhood. And I think sentiment in terms of bonds is becoming pretty bearish right now. So rates could trade sideways for a bit, so then you could play this oversold condition that we have right now in tech. But I do think that cyclicals rule the day longer term. And I think a lot of it is going to come in the summertime when we get these inflation fears. You know, right now, if you look at 40% of the people who aren't working, they're actually making more money because of the stimulus than they would if they had jobs. So I think you could have this labor shortage just as the economy is starting to pick up steam. Folks get really concerned about inflation, and what does that do? It pushes nominal interest rates higher. Not good for tech. On the flip side, I think what that does is it pushes real rates actually lower, so it continues to force people out the risk curve into stocks, and it's likely into cyclicals under those conditions.
Yeah, Bonawyn, do you think tech is oversold right here? And do you think it's tradable? Or do you think the play is really to just go all in cyclicals?
No, I definitely don't think that the play is going all in cyclicals, but I think that there's a lot of merit to what the other panelists have been saying, right? So the way I really like the question that you asked, and what you said is, are the best dates behind it? Well, are we going back to a pandemic-induced situation where tech is going to outperform, where we're at historically low rates? That's not coming back. So to expect to make 400-500% in these names, I think that's a bit outlandish. So do I expect that to be replicated in the short term or long term? No, I don't. With that said, I do not think you should be throwing out the baby with the bathwater. There are different subsectors within technology. Facebook, Apple, these names are trading in high 20s price to earnings. Google's trading at like 30, 31. Compare that to some of these names like CrowdStrike that are trading at 200-300 times price to earnings. So there needs to be some decoupling. So I'm just not with the notion of saying tech as a whole, you can't invest or trade in it. I do think you do need to slide further back on the risk curve into names that have fortress balance sheets, that have shown sustainable growth and have a use case now and in the future.
So basically, technology has to be viewed as a different sort of component in your portfolio. Before, they were the source of growth in your portfolio. And now, Bonawyn, it sounds like you're saying they're a defensive stay, like I don't want to say a staple because maybe that's overstating it, but sort of an anchor position. It's not going to move too much, but it's not going to burn you.
Exactly. A name like Microsoft, I still think you can have it as a store of value, right? So again, it's just really having to kind of revamp one's playbook in the situation that we're in. The rate acceleration and the pace at which rates have accelerated has led to all of this volatility.
Right.
I don't expect that to continue to persist.
I think it's interesting what Bonawyn said in terms of we're not going to be in a pandemic again, knock on wood, because we don't really know that. But we hope we aren't going to be in a pandemic again. And that was the context for this massive run in technology. Well, we're not going to be coming out of a pandemic again, Steve Grasso. So in terms of the cyclical trade, at some point, doesn't it price in this huge amount of growth, pent-up demand, all that stimulus, the savings that people have stored away around the world? That's going to happen once, right? And then wane.
Right. So let me just give a caveat before I answer that one. I think you can make the case that Apple, Google, to agree with Bonawyn and Nadine and the General, Apple, Google, you can make a case, and Microsoft, that they are value plays within tech. They should therefore get hit the least out of that tech complex. But when you talk about pent-up demand, Melissa, we've never come out of a pandemic. So no one has any clue what the pent-up demand is going to be. So I think it's going to outpace everybody's sort of intuition as to how big it's going to be. Could you imagine? People are going to be taking trips they never even thought about taking. People are going to be going out to dinner. I'm seeing highways crowded, sidewalks crowded, stores crowded, restaurants crowded, all within legal limits, of course. But there's going to be so much more than any of us can possibly imagine. So to put a tag on it, and by the way, couple that with the fact that cyclicals and value stocks have underperformed for the last 15 years. So once everyone starts to take a look at what a cyclical and what a real diversified chemical and what a material stock looks like, then you're going to start to see how it
you are
overperforms.
You are making the case that people were making for technology and valuations during the pandemic, which is valuations, I don't want to say don't matter, but valuations matter less because you're saying there is no playbook here. We don't know how brisk the business is going to be. And so therefore, you can't judge a stock by what it's trading at right now or what it's pricing in for the future. Correct.
I think that you are going to see this economy blow through the roof. The most consensus view, and I'm guilty of it too, I'm waiting for that sell-off to happen. The problem is things look too good in the economy. You're going to have a blow through the roof economy that's going to trip over itself. And the most non-consensus thing is that the S&P looks like you're going to rip through 4,000 and get to 4,500. Nobody's saying that except for a handful of people.
All right. Well, there were a few standout stocks in today's record rally, so we want to see if you guys like them. Names like John Deere, GM, Goldman Sachs, DraftKings hitting their highest levels on record. Have these stocks, though, gone ahead of themselves? Let's find out in a good old-fashioned game of Trade It or Fade It. That's right. Never gets old. Trade it or fade it, the record high club. Let's start off with Deere up 37% this year. Nadine, trade it or fade it?
I think you trade it on the intermediate term, but you fade it today. We're looking at a risk range that we have internally of 5-1 to the downside. So you obviously don't want to buy into that, but you do want to hold this for an intermediate term trade if you can get it.
All right. Bonawyn, what do you say?
I think you've got to fade this thing. It's up about 40% since January. It's up above its pre-pandemic highs. Its price to earnings are above its pre-pandemic highs. I mean, this to me is an example of a lack of value within value.
All right. Let's move on to DraftKings. That is up 54% this year. Steve Grasso.
I'm going to say fade this one. Now, I get the whole idea of why it's been popular, and I do understand that we're starting to see sports open back up, and that's seen as a tailwind. But I think the biggest tailwind for the stock has probably lost its steam. I'd rather go with the more traditional casino players like a Penn Gaming, an MGM on an economy reopening versus an online thing like DraftKings.
I'm going to guess that Jeff Mills thinks you're wrong. Jeff, what do you say?
I am going to trade this one. It's been a really interesting stock, actually. It's bucked the trend. Bonawyn said it during our call earlier today. But these really high-flying growth names. Penn was down today. A lot of other stocks like that were down. DraftKings was up. And, although I can understand the view that, at over $70, it's pricing in some of this news. But massive pent-up demand. After this next stimulus bill, you're talking about $2 trillion in excess consumer savings. You have the stimulus checks rolling out. And I just think there's an underestimation of what this market's going to look like. If you go to the Super Bowl, you couldn't even log into FanDuel, Penn, DraftKings. I mean, not a good look for the companies at that point in time. But you're talking about a 60+% increase in online gambling around the Super Bowl. I just think there's a lot of room here, and you still have a ton of legal catalysts in terms of legislation getting passed.
All right, let's get to our next stock. Darden Restaurants, the owner of Olive Garden. Nadine, what do you say?
You trade it on the intermediate term, it's going to keep with the reopening plays, but then you got to fade it on the near term. Again, 5-1 downside. They're going to have trouble hiring people. Food and labor costs are going up. And then they're digital. They're planned for digital here. What they've learned recently is that people want to go to their restaurants. They don't want to take it out. And so as people come back into the restaurant, vaccines are given, and you get your 2-month wait, what you're going to find is that people will start cannibalizing one part of their business for the other.
Jeff.
So I'm going to trade it. Quick anecdotal example. But if you go back to the summertime, Fogo de Chao, the Brazilian steakhouse, when we got the first stimulus, they were starting to initially ease COVID restrictions. They usually sell about 500 premium steaks a week. They were selling 1,300 a week at that point in time. So obviously anecdotal, but I do think it's emblematic of the kind of spending that we're going to see. And specifically with Darden, they've been doing a really good job controlling costs. They have a diversified group of pretty well-known brands. I think if you look out to 22, where earnings will be a little bit more normalized, I think the valuation makes sense.
All right. Finally, General Motors is up 40% this year. Bonawyn, trade it or fade it?
I'm trading this one, and I think this falls squarely into exactly what Steve has come up here and said time and time again. This is a name, you've seen strength in durables, it's set up to take advantage of EV, and it has a logistical prowess to be able to take advantage of what we're going to see in demand going forward. I'm trading this one. Hats off to Steve.
All right, coming up, a major cybersecurity firm is warning a massive hack attack could be coming within the next few hours. How you can protect yourself and your information. We've got the full report next, and later we've got a chart of the week for you. The stock is rallying 21% since Monday. We'll reveal the name and the trade when Fast Money returns.
Chihuahua caramba! Kevin O'Leary here. Money Court is all about dispute resolution. Businesses have problems, and I'm here to resolve them.
Money Court with Kevin O'Leary. New series, Wednesdays 10 Eastern on CNBC TV.
Welcome back to Fast Money. We're following new developments on that massive hack attack. One top cybersecurity firm issuing a major warning tonight. Let's get to Eamon Javers with all the details. Eamon.
Yeah, Melissa, here's something to keep an eye on as we head into the weekend here. A warning now from Mandiant, their vice president, John Hultquist, pointing out the possibility now of potential ransomware attacks. Here's his statement. He says, we are anticipating more exploitation of the exchange vulnerabilities by ransomware actors in the near term. Though many of the still unpatched organizations may have been exploited by cyber espionage actors, criminal ransomware operations may pose a greater risk as they disrupt organizations and even extort victims by releasing stolen emails. So this is all the follow-up to that Microsoft Exchange hack that we saw reported on so extensively last week. Over at the White House today, we saw the National Security Advisor, Jake Sullivan, admitting that the administration is still struggling to get its arms around the scale and scope of this entire hack. Here's what he said.
The precise number of systems that have been exposed by this vulnerability and have been exploited either by nation-state threat actors or ransomware hackers or others, that is something that we are urgently working with the private sector to determine. It is certainly the case that malign actors are still in some of these Microsoft Exchange systems, which is why we have pushed so hard to get those systems patched.
So Sullivan there saying the bad guys are still in a lot of these servers. We think the cybersecurity industry broadly thinks that those bad guys are the Chinese. The White House not pointing the finger specifically to the Chinese government just yet, saying attribution is still to come. But the way this ransomware works, Melissa, is that the companies that are being hit hard by it may already know that they've been hit hard by it, and someone is extorting them already, demanding payment or else threatening to leak the emails. You know, we could see that start to happen in the coming days if those companies decide, you know what, we're just not going to pay these extortionists.
Eamon, quick question. I read that that about a third of the vulnerable Microsoft Exchange customers have not yet patched their systems yet. This is according to BitSights. And I'm wondering at this point with this warning, if they went ahead and patched their systems, if that could protect them from this next layer.
Well, it's something that you have to do, and the White House is urging everybody to patch their systems, to pay attention to what the Microsoft warnings were on this. They've put out exactly what you need to do. But, you know, in many ways, patching your systems now is a little bit like locking your front door with the burglar still in the house, right? It's going to prevent the other burglars from getting in, but it doesn't do anything about the guy hiding in your closet. You still have to go through your entire house and make sure that there's nobody else left inside. And if you find somebody, throw them out the window. That's kind of where we're at. You have to lock the door and you have to search the closets.
All right. Eamon, thank you. Eamon Javers staying on top of the story for us. This week, cybersecurity names, a lot of them have done quite well. FireEye, for one, is up about 8%, 9%. Jeff Mills, hacks like this, does this underscore, well, obviously it underscores the need for cybersecurity. Does it get corporations to increase spending?
No doubt. And whether it's now or later, companies are going to have to increase spending. I mean, this is the new front line. This is not going anywhere. And companies that are exposed to it are subject to a massive growth tailwind. Now, I even think about a company like Palantir. We talk about it a lot on the show. And, you know, at its core, cybersecurity risk is data related, and to be able to get a view of your network in real time and to be able to figure out where the vulnerabilities are, I think a company like Palantir can continue to do really well. And that stock showed me something these past few weeks. We talked about 22 as being that support level. It held really nicely as some of those SPAC type names were not doing so well. So I'd feel pretty comfortable buying it here. A
lot of these names, though, might get caught up in sort of the software sell-off trend or the high multiple name trend, Nadine. So would you still stick with them as a group, or do they get swept up?
This is exactly the type of business you then want to trade, right? So even if you do have a broad brush day where all tech goes down, what you're seeing, what Steve is saying here, is that there's a secular trend. This is not something that was just a beneficiary of the pandemic. And there's going to be increased growth and need for companies to spend on it, to train on it. And it obviously, the increase in data and the need for data centers and for software in those data centers, it just gets exponential. So we like these types of businesses. It is something that you can hold on to and then buy the dips.
Up next, we'll reveal our chart of the week. This stock taking flight and rallying more than 20% since Monday. Whoops, that was a clue. We'll reveal this high flyer when Fast Money returns. Welcome back to Fast Money. Time to reveal our chart of the week. This stock seeing some serious altitude since Monday. It's Boeing. That's right, the aerospace company rallying more than 20% with travel rebounding and orders for the 737 MAX increasing. Grasso, it's almost like a trade it or fade it, basically. Yeah. But, would you stick with this one?
So this is one, if you look at it on a chart, it built a heck of a base where things were probably unknown. And now you're starting to see the reopening of the economy. If you chart this one on, I like looking at the fib levels, Fibonacci retracement levels. And if you go to the prior high before the pandemic started to the pandemic low, you come up with a 50% retracement that's at $267. So the stock is above that now. Technicians like to sell the stock between the 50 and the 618. The 618 is about $309, so you have some room to the upside. I would still stay in the trade, so trade it.
Bonawyn, what would you say?
I'm happy to miss this one. I think this is testament to the reopening trade, but the whole enterprise value swelling because of ballooning debt balances gives me pause. I'm happy to raise my hand and say, you know what, I'll just miss it.
Jeff Mills, just quickly, would you rather Boeing or an airline stock?
Yeah, perfect question, because I've been saying I would rather play airlines to get that beta of increased travel and just the reopening trade in general. But my favorite airline, which is Southwest, which I've been talking about for a number of months, that's now above its pre-pandemic highs. So I think there's actually more room in Boeing here.
All right. Time for the final trade for this Friday. Let's go around the horn. Nadine Turman, what do you say?
I'd say do-free. On the flight topic here, gotta love the duty-free shopping. They've upgraded the shopping areas, and so as luxury travelers get going, this one's going to win.
All right. Bonawyn.
Speaking of the reopening trade, I do think that you can play momentum in the cruise lines. Carnival Cruise is my preference there, but I'd be trading that.
Steve Grasso.
I'm staying solid with SPACs. WPF is due for a heck of a bounce. It's time to end this silly underperformance. WPF, buy it.
General, Jeff Mills.
So I like Illumina. They are the global leader in DNA sequencing. I actually fast pitched the stock a few months back. It had a huge run. It's come back a bunch. It held really nicely at long-term technical support, so I would definitely be a buyer here.
All right. Thanks, all. That does it for us here on Fast Money. We'll see you back here Monday at 5 for more Fast. Meantime, don't go anywhere. Options action is up right after this quick break.
Chihuahua caramba! Kevin O'Leary here. Money Court is all about dispute resolution. Businesses have problems, and I'm here to resolve them.
Money Court with Kevin O'Leary. New series, Wednesdays 10 Eastern on CNBC TV.